Your IRA balance looks healthy. Maybe it's 300,000, 500,000, or even $1 million. You've been diligently contributing for decades, watching that number grow and feeling confident about retirement. But here's what nobody told you. That balance isn't really yours. Not entirely. The IRS has a silent partnership in your IRA, and they're going to collect their share eventually. For most retirees, that share is going to be $50,000, $100,000, or even $300,000 more than it needed to be. I'm talking about the tax bomb that's ticking inside every traditional IRA and 401k in America. It's a problem created by decades of deferring taxes, compounded by required withdrawals that start at age 73, and detonated by a tax code specifically designed to push retirees into higher brackets just when they can least afford it. The shocking part, most people approaching retirement have absolutely no idea this is coming. We are on a mission to reach 10,000 subscribers to build a community that is aware of these financial shifts. If that resonates with you, hit subscribe. What I find so deeply troubling about this situation is how the retirement savings system in America has fundamentally misled people about the true value of their accounts. When you see $500,000 in your IRA, you think, I have $500,000 for retirement. But the reality is, you have $500,000 that must be withdrawn over your lifetime, with every dollar taxed as ordinary income. If you're in the 22% tax bracket, you actually have $390,000. If withdrawals push you into the 24% bracket, you have $380,000. And if you get hit with the dreaded IRMA surcharges on Medicare because of those withdrawals, your effective tax rate could be 40% or more. Your $500,000 is really $300,000. This isn't just about paying taxes you always knew you'd owe. This is about the systematic way the tax code, Social Security taxation, Medicare premium surcharges, and required minimum distributions combine to extract far more from your retirement accounts than you ever planned for. It's a financial ambush that hits at exactly the moment when you're most vulnerable. When you're no longer working, your income is fixed, and you have limited options to adapt. Let me tell you, what I've discovered by analyzing the mechanics of this tax bomb is that it's not an accident. It's the predictable outcome of policy decisions made decades ago that are now coming home to roost for millions of baby boomers. And the fuse is getting shorter every single year. Let's start with the mechanism that triggers this entire disaster, required minimum distributions, or RMDs. Under current law, once you turn 73, you must begin withdrawing money from your traditional IRA and 401k accounts, whether you need it or not. The government forces you to take these distributions, and every dollar is taxed as ordinary income. Here's how the math actually works, and I want you to pay close attention because this is where the trap snaps shut. Your RMD is calculated by dividing your IRA balance by your life expectancy factor from IRS tables. At age 73, that factor is approximately 26.5. So if you have $500,000 in your IRA, your first RMD is $18,868. At age 75, the factor drops to 24.6, making your RMD about $20,325. At age 80, the factor is 20.2, and your RMD is 24,752. At age 85, the factor is 16.0, and you're forced to withdraw $31,250. Notice what's happening here. Even if your account balance stays roughly the same through modest growth, your required withdrawal increases every single year because the life expectancy factor decreases. You're being forced to take out larger and larger amounts, which means larger and larger tax bills, even though your actual spending needs might not be increasing at all. But it gets worse. Much worse, because these RMDs don't exist in isolation. They stack on top of your Social Security income, any pension income, any part-time work, and any other investment income you have. This stacking effect is where the real tax bomb detonates. Let's walk through a realistic scenario. You're a married couple, both 73 years old. You receive $45,000 per year in combined Social Security benefits. You have $600,000 in traditional IRAs. Your first year RMD is about $22,640. Your total income is now $67,640. You're comfortably in the 12% federal tax bracket, right? Wrong. Here's what actually happens. Up to 85% of your Social Security benefits become taxable once your combined income exceeds certain thresholds. For a married couple, that threshold is $44,000. Your RMD of $22,640 combined with 50% of your Social Security, $2,500, puts you at $45,140 over the threshold. Now, 85% of your Social Security, or $38,250, becomes taxable. Your actual taxable income isn't $22,640, it's $60,290. You're paying federal income tax on money that's supposed to be Social Security benefits. And we haven't even gotten to state taxes, Medicare IRMA surcharges, or what happens when one spouse dies and the surviving spouse's tax situation becomes even worse. This is the tax bomb, and it's exploding in slow motion across millions of retirement accounts right now. This reminds me of what engineers call a cascade failure, when one system failure triggers another, which triggers another, creating a chain reaction far worse than the initial problem. RMDs trigger taxable Social Security. Taxable Social Security triggers higher Medicare premiums. Higher taxable income triggers higher state taxes. Each element compounds the others, creating an effective tax rate far beyond what you see in the federal tax brackets. Now, let's talk about how this tax bomb gets amplified by Medicare premium surcharges. I've discussed IRMA before, but in the context of IRA withdrawals, it becomes particularly vicious. Remember, IRMA looks at your modified adjusted gross income from 2 years prior. Your IRA withdrawals, both voluntary ones and required RMDs, count as income for IRMA purposes. Here's where the numbers become truly painful. Let's say your RMD pushes your income to $105,000 as a single filer. You've just crossed the first IRMA threshold of $103,000. Your Medicare Part B premium jumps from $164.90 per month to $230.80, an increase of $791.40 per year. Your Part D premium adds another $154.80 in annual surcharges. That's $946.20 in additional healthcare costs every year, not because your health changed, but because of a forced IRA withdrawal. But here's the truly insidious part. That $946.20 in additional Medicare costs isn't deductible. It comes out of your after-tax income. So to pay for it, you actually need to withdraw even more from your IRA to cover the tax on the withdrawal needed to pay the Medicare surcharge caused by the previous withdrawal. It's a recursive tax trap. Let me break down the real math. You need an extra $946 to pay the IRMA surcharge. But if you're in the 22% federal bracket and pay 5% state tax, you need to withdraw $259 from your IRA to have $946 after taxes. But that additional $1,259 withdrawal increases your taxable income, potentially pushing you further into the next IRMA bracket or making more of your Social Security taxable. You end up in a spiral where IRA withdrawals create Medicare surcharges that require more IRA withdrawals that create higher taxes that require even more withdrawals. What I find particularly cruel about this system is the 2-year look back. You could have a one-time large IRA withdrawal in 2024. Maybe you needed money for a medical procedure or to help a child. And 2 years later, in 2026, you're hit with elevated Medicare premiums, even though your income is now back to normal. You're being penalized for income you no longer have, with no way to undo the damage. For couples with substantial IRAs, the IRMA impact can be staggering. A married couple with combined RMDs that push their income to $330,000 are paying $9,194.40 per year in additional Medicare premiums beyond the standard rates. That's nearly $10,000 annually in healthcare surcharges directly caused by forced IRA withdrawals. Over a 20-year retirement, That's $190,000 in additional costs that could have been avoided with proper planning. Now, I want to address what I believe is the most devastating aspect of this tax bomb. What happens when one spouse dies? This is where the entire system reveals itself as particularly cruel to surviving spouses, especially women who statistically outlive their husbands. Here's the scenario that plays out thousands of times every single day across America. A married couple has been filing jointly. They're both receiving Social Security. They have substantial IRAs. Their combined income puts them in the 12% or 22% federal bracket. Then one spouse dies. Suddenly, everything changes for the worse. The surviving spouse now files as single. The tax brackets for single filers are approximately half the width of married filing jointly brackets. What was a comfortable 12% bracket as a married couple becomes a 22% or 24% bracket as a single filer, even though actual income has only dropped by one person's Social Security benefit. Meanwhile, the surviving spouse inherits the deceased spouse's IRA, which means the RMDs continue or even increase. But now those RMDs are being taxed at dramatically higher rates. Let me give you concrete numbers. Married couple, combined Social Security of $48,000 annually, combined IRAs of $800,000, combined RMDs of $30,000. Their taxable income is approximately $71,000. They're solidly in the 12% federal bracket. The husband dies. The widow keeps the higher of the two Social Security benefits, let's say $30,000. She inherits the full IRA, now $800,000 in her name. Her RMD is still $30,000, but now her taxable income as a single filer is approximately $55,500, and the 12% bracket for single filers ends at $47,150. She's now in the 22% bracket. Her effective federal tax rate just increased from 12% to 22%, an 83% increase, while her income actually decreased. She's paying dramatically more in taxes on less money. This is what tax experts call the widow's penalty, and it's devastating to millions of women who spent their lives contributing to retirement accounts alongside their spouses, only to see those accounts ravaged by taxes after their husband dies. And remember, this widow now has half the Social Security income, but the same fixed costs for housing, utilities, property taxes, and health care. The RMD forces her to withdraw $30,000 annually and pay $6,600 in federal taxes, 22% bracket, leaving her with $23,400. Combined with her $30,000 Social Security benefit, her after-tax income is approximately $53,400. If she was previously living on $90,000 as a couple, she's now trying to maintain a household on 60% of that income, while her tax rate has increased. This isn't theoretical hardship. This is real financial stress that leads to widows selling their homes, moving in with children, or making devastating choices between healthcare and food. And it's all because of how RMDs interact with the tax code after the death of a spouse. What makes this tax bomb even more destructive is that we've only been discussing federal taxes. 13 states also tax Social Security benefits to varying degrees. 41 states tax IRA distributions as ordinary income. When you add state taxes on top of federal taxes, IRMA surcharges, and the taxation of Social Security, the effective tax rate on IRA withdrawals can approach or exceed 40% for middle-class retirees. Let's take California as an example. A single retiree in California with $80,000 in income, including RMDs, is paying 22% federal tax on the top portion of their income, 9.3% California state tax, and they're in the second ERMAA bracket with surcharges of $791.40 annually. On the marginal dollar of IRA withdrawal, they're losing 0.22 to federal tax, 0.093 to state tax, and potentially triggering additional IRMAA surcharges. The effective marginal tax rate is over 31%, and that's before considering that the withdrawal might make more Social Security taxable. In states like Minnesota, Oregon, or Hawaii, with high state income taxes and full taxation of Social Security benefits, the situation is even worse. A retiree can easily find themselves in a position where taking $10,000 out of their IRA results in only $5,500 to $6,000 in actual spendable money after all taxes and surcharges. They're losing 40 to 45% of every dollar to various government agencies. What I find so disturbing about this is how it contradicts the fundamental promise of tax-deferred retirement accounts. The pitch was always contribute now when you're in a high tax bracket, withdraw later when you're in a low tax bracket, and save on taxes. But for millions of retirees, they're not in a lower bracket. Between RMDs, Social Security taxation, IRMA surcharges, and state taxes, their effective tax rate in retirement is higher than it was during their working years. The promise was a lie. Here's where I want to shift from the problem to the solution, because there is a way to defuse this tax bomb. It's called Roth conversions, and it's the single most powerful tax planning strategy available to people approaching retirement. But it requires understanding and action years before you hit age 73, which is why most people miss the opportunity entirely. A Roth conversion is when you voluntarily withdraw money from your traditional IRA, pay taxes on it now, and move it into a Roth IRA where it will grow tax-free forever. All future withdrawals are tax-free. Roth IRAs don't have RMDs during your lifetime. They don't trigger Social Security taxation. They don't cause IRMA surcharges. They pass to heirs tax-free, though heirs must withdraw within 10 years under current law. The strategy is to do systematic Roth conversions during the years between retirement and age 73, what financial planners call the conversion window. Let's say you retire at 62 and delay claiming Social Security until 70. From age 62 to 70, your taxable income is low. You're living off savings, maybe some part-time work, but you're not yet taking RMDs and you're not yet taking Social Security. This is your opportunity. During these 8 years, you strategically convert portions of your traditional IRA to Roth, paying taxes at low rates. You might convert $50,000 per year, filling up the 12% or 22% federal bracket. You pay $6,000 to $11,000 in federal taxes on each year's conversion. Over 8 years, you convert $400,000, paying approximately $48,000 to $88,000 in total taxes. But here's the payoff. When you turn 73, your RMDs are calculated based on a much smaller traditional IRA balance. Instead of having $800,000 generating an RMD of $30,000 annually, you have $400,000 generating an RMD of $15,000. Your taxable income stays lower. Less of your Social Security becomes taxable. You avoid IRMA surcharges. You stay in lower tax brackets. And if your spouse dies, the widow isn't devastated by the filing status change because the RMDs are much smaller. Let me show you the lifetime tax savings. Original scenario, $800,000 IRA, annual RMDs starting at $30,000 and increasing, 20 years of withdrawals totaling approximately $700,000, taxed at average effective rate of 25%, ensure $175,000 in lifetime taxes, plus IRMA surcharges of $2,000 per year sorts you $40,000. Total tax cost, $215,000. Roth conversion scenario, convert $400,000 over 8 years, pay $68,000 in taxes during conversion period. Remaining $400,000 generates smaller RMDs, taxed at average effective rate of 15% on total withdrawals of $350,000, $50,500 in lifetime taxes. No IRMA surcharges because income stays below thresholds. Total tax cost, $120,500. Total savings, $94,500. And this doesn't even account for the fact that the $400,000 in the Roth IRA grows tax-free and can be withdrawn without tax consequences whenever needed, providing flexibility and tax diversification that dramatically improves retirement security. This reminds me of the concept of paying tax when it's on sale. During your peak earning years, tax is expensive. you're in high brackets. During the conversion window, tax is cheap, you're in low brackets. After RMDs start, tax becomes expensive again. The window of opportunity to buy low is limited, and it closes permanently once RMDs begin. For those who are already past age 73 and facing RMDs, there's still a powerful strategy to reduce the tax impact: qualified charitable distributions, or QCDs. If you're 71, 2, or older, you can direct up to $105,000 annually as of 2024, adjusted for inflation, from your IRA directly to qualified charities. This amount counts toward your RMD, but it's not included in your taxable income. The tax savings are substantial. Let's say your RMD is $35,000, but you only need $25,000 for living expenses. You're charitably inclined and normally donate $10,000 per year to your church and other causes. Instead of taking the full $35,000 RMD as taxable income and then writing checks to charity, you direct $10,000 as a QCD straight from your IRA to the charities. The result, only $25,000 shows up as taxable income. You avoid paying tax on the $10,000 that went to charity. If you're in the 22% bracket, that's $2,200 in tax savings. It doesn't trigger additional Social Security taxation. It doesn't push you into IRMA territory, and the charity receives the full $10,000. Nothing is lost to taxes. Over a 20-year retirement, if you do this every year, you save $44,000 in federal taxes alone. For couples who are charitably inclined, both spouses can do QCDs from their respective IRAs, potentially directing $210,000 per year to charity while dramatically reducing their tax burden. What I find frustrating is how few people know about QCDs. Even financial advisors sometimes overlook this strategy. Retirees write checks to charity from their checking account and then take RMDs that get fully taxed, when they could be satisfying their RMD requirement and their charitable intent simultaneously while paying zero tax on that portion of their IRA. Let me be very direct about the action steps you need to take immediately based on your age and situation. If you're 55, 62, and still working, start planning your Roth conversion strategy now. Calculate how much you'll need in retirement versus how much is in traditional IRAs. Consider doing partial conversions even before retirement if you have years where your income dips. Every dollar converted now is a dollar that won't create RMD problems later. If you're 62, 72 and retired but not yet taking RMDs, this is your critical window. Get professional help to calculate optimal Roth conversion amounts. Generally, you want to convert enough each year to fill up to the top of the 12% or 22% bracket without triggering higher brackets or IRMA surcharges. This is complex math, but it's worth tens of thousands in tax savings. If you're 73 plus and facing RMDs, calculate your projected RMDs for the next 10 years. Look at your income, including Social Security. Determine if you're approaching RMAA thresholds. If you're charitably inclined, implement QCD strategies immediately. Consider whether Roth conversions still make sense for amounts above your RMD. If you're married, model what happens to the surviving spouse when one of you dies. Look at the tax brackets for single filers versus married filing jointly. If there's a big IRA balance, this should terrify you into action. Consider whether the higher earning spouse should do aggressive Roth conversions to protect the surviving spouse from the widow's penalty. If you have adult children who will inherit your IRA, understand that under current law, they must withdraw the entire inherited IRA within 10 years. This will likely push them into high tax brackets during their peak earning years. Every dollar you can convert to Roth now is a dollar they won't pay tax on later. This is estate planning through tax planning. What I want to leave you with is an understanding of why this tax bomb exists and what it reveals about retirement policy in America. Traditional IRAs and 401ks were created in the 1970s and 1980s as a way to encourage retirement saving. The government gave you a tax deduction for contributions, but the trade-off was that all withdrawals would be taxed later. This seemed like a reasonable deal at the time, but what's happened over the past 40 years is that millions of Americans did exactly what they were told. They maxed out their 401k contributions. They rolled over their accounts when changing jobs. They watched their balances grow, and now they've accumulated $500,000, $1 million, or more in traditional retirement accounts. The problem is that the tax code has simultaneously become more punitive to retirees. RMDs force distributions whether you need the money or not. Social Security taxation means up to 85% of benefits are taxable. IRMA surcharges penalize even modest retirement income. State taxes add another layer. The interaction of these systems creates effective tax rates that would shock most people if they understood them. What I find so troubling is that this isn't accidental. These are deliberate policy choices made over decades. RMDs exist because the government wants tax revenue. They don't want money sitting in IRAs indefinitely. The reduction of RMD starting age from 12 to 72 and then to 73 was grudgingly done, and only because of the pressure from an aging population. The default trajectory is toward forcing withdrawals earlier and taxing them more heavily. The tax bomb in your IRA isn't really a bomb. That implies something sudden. It's more like a slow draining leak that persists for 20 or 30 years, siphoning off 50,000, 100,000, 200,000 or more that could have been yours if you'd understood the rules and planned accordingly. For most Americans, this represents one of the largest financial losses of their lifetime. Money they worked decades to earn, saved diligently, and watched grow, only to see it extracted through taxes at rates far higher than necessary. The solution exists. Roth conversions, QCDs, strategic withdrawal timing, and careful management of taxable income can dramatically reduce this tax burden. But it requires knowledge most people don't have, planning most people don't do, and action during specific windows of opportunity that most people miss. The system is designed to be complex enough that the vast majority of people simply pay the full freight of taxes without realizing there was a better way. Don't let the 50,000, 100,000, or 300,000 tax bomb in your IRA detonate without a fight. The fuse is burning, but you still have time to defuse it. The question is whether you'll take action before it's too late.